Okay, welcome back. Second part of chapter 5. We talked about capital and what it's from and what it's for and where it comes from um, in terms of investment capital. So the advantage of equity capital is we never have to pay it back. The organization is not required, has no legal obligation to pay back money that's invested by equity holders. So that's a good thing for the company. It provides what's called patient capital or permanent capital for the company and or for the organization. And that permanent capital can then be leveraged. And we'll hear a lot about leverage over the next few lessons, few lectures, and few weeks of this class. Can then be leveraged with borrowed money. So the lender looks at the capital structure of the company, sees equity holders who are permanent or patient capital, and feels more comfortable lending money to an organization that has some permanent capital. They're more likely to be repaid, and therefore they're more willing to lend. So that's how common stock is used. Let me go here. So when we borrow, it's different. When we borrow money, we have to repay it. And we have to repay it with interest. And we have to repay it within the terms of whatever loan agreement we have. So this is a different kind of capital. This is capital that we have to repay, whereas equity capital, we don't have to repay. So this is not permanent or patient capital. Some long-term debt certainly is more permanent than short-term debt, but it all has to be paid back. And I think you saw some examples of that in the companies that you analyzed. So when you have to pay back your loan, you have to pay it within the terms of the agreement. Most loans have covenants requiring you to meet certain requirements, income requirements, or interest coverage requirements, or debt to equity ratios. All sorts of things can be in covenants, and you have to keep on top of those covenants in a borrowing situation. When a company borrows money, if they can invest that borrowed money at a higher rate of return than they're paying for interest, that allows them that difference accrues to the shareholders, to the equity holders. So if I can borrow at 3% and invest that money at 6%, then that extra the difference between the 3% and the 6% flows down to the income statement to the stockholders. So it's a good thing to borrow. Leverage allows you to earn more money for your stockholders. It also carries greater risk, and we're going to spend a lot of time looking at that risk reward a little later on. Here we're just trying to define what we're looking at. So significantly two kinds of debt. There's long-term debt and short-term debt. Long-term debt does not have to be paid within 12 months. That's the accounting definition. So it doesn't have to be repaid currently, and that generally strengthens a company's liquidity. So if you have long-term debt, you borrow money long-term, what you get for that is cash, which is a short-term asset or current asset. So you get a current asset and you get a long-term liability. So your current ratio, your current assets over current liabilities improves. So your liquidity improves. Corporations generally can borrow long-term either from banks, or they can issue bonds, which is essentially borrowing directly from the lender, from investor. Banks are not inclined to lend long-term. They'd much prefer lending short-term. They do some long-term lending, but generally banks are short-term, prefer to be short-term lenders. They are short-term lenders primarily because their borrowing, which is your deposits, are short-term. They have to be able to pay those back immediately. So if you've got short-term borrowing and you lend it long-term, that's a riskier position than short-term to short-term. So banks tend to like to lend short-term. Doesn't mean they don't lend long-term, but they're much more likely to lend short-term. Bonds are securities, like stocks, that are issued directly by a corporation or sold directly by a corporation to someone who wants to lend money to that corporation. So there is no middleman. The bank isn't there as a middleman. So generally bond borrowing is more economic both for the lender and the borrower because there's no middleman taking a cut. So when a company borrows by issuing bonds, they're borrowing directly from the lender. They don't go through a bank. So the lender will generally accept a lower interest rate than the bank would. And when the lender buys bonds, they generally get a higher interest rate than they would by lending their money to a bank. So it's beneficial for both sides of the transaction. That's why bonds exist. I'm going to talk a little bit about what a bond is. So a bond is a contract. It's a piece of paper that obligates the borrower to repay whatever stated amount, the principal or face amount of the bond, at a specific maturity date. Traditionally, bonds pay interest twice a year. There's no requirement that they pay interest twice a year, but that's what most bonds pay, interest twice a year. And generally, the principal on a bond is paid back at the end. So if I borrowed $100,000, if I issued a $100,000 bond for 10 years at 10% interest, I would pay interest of $5,000 every 6 months, or $10,000 a year. And at the end of 10 years, I would pay the bondholder the principal back, the $100,000 that they'd lent me. So no principal is paid during the period of the bond, it's paid at the end. It's not, once again, not required. That's what most bonds are. There are basically two kinds of bonds, secured bonds and unsecured bonds. Secured bonds are secured by a specific piece of property or an asset. So in the event that the lender does not pay within the terms of the agreement, the bondholder has the right to take the asset. I think all of us are familiar with home mortgages. Home mortgages are secured debt. So you, as the borrower, are required to pay your monthly payment, principal and interest on the mortgage. If you fail to pay your required payments, the lender has the right to take the property that's securing the loan. So they have the right to take your house, the home mortgage, and sell it, foreclose upon it, and then sell it to recover the money that they're owed. That's a secured loan. Secured bonds have the same rights. They're secured by an asset of the corporation, and the lender has the right to take the asset that it's secured by in the event that the company does not pay them. Unsecured bonds, just the opposite. Their only recourse is the full faith and credit of the borrower. So I promise to pay you. If I don't pay, then you can force me into bankruptcy, and you are in line with all the other creditors after the assets are liquidated. So you don't have any preference over the other creditors. We're going to sell all the assets, we'll have a pool of money, and we'll divide it up amongst the creditors. Secured bondholders have more rights. They have the right to take a particular asset. So a secured bondholder, I'll give you an example. In the financial crisis of 2008, General Motors went through bankruptcy. General Motors had issued both secured bonds and unsecured bonds. So they had a lot of people they owed money to, billions of dollars in actuality. The secured bondholders ended up getting a much better deal in the bankruptcy court than the unsecured bondholders because they had security in some of the production facilities of General Motors. So if they went to the bankruptcy court and said, well, we have a right to take these assets. If we don't get a good enough deal, we're just going to take the production facilities. And of course, if they took the production facilities, then General Motors would not be able to go through a Chapter 11 reorganization and operate because they wouldn't have any place to produce their cars. So the secured bondholders ended up getting about 80 cents on the dollar, what they'd lended. So if they had lent General Motors $1 million, they would they did receive about $800,000 on that $1 million loan. Unsecured bondholders only got about 30 cents on the dollar. So if they'd lent General Motors $1 million, they got $300,000 in the bankruptcy proceedings. So the secured bondholders came out much better. Point is that if you are an investor in bonds, you should know whether you're buying secured or unsecured bonds. And secured bonds generally have a lower risk of default because they're secured by specific assets. So if the bondholders for TDW have secured bonds, they would have probably security in the ships that TDW owns. And in the event of a bankruptcy, they would be able to say, well, we'll just take the ships, just give us the ships and we'll sell them to get our money back, as opposed to allowing TDW to go through a Chapter 11 procedure and continue to operate. TDW doesn't have ships, they can't operate. So they have leverage. Usually they don't end up taking, in most corporate bankruptcies, they don't end up taking possession. They use their right to take possession to extract a better deal for themselves, which means the other creditors get less. Callable and non-callable, important to know the difference between callable and non-callable bonds. Callable bonds are bonds in the bond agreement. It allows the issuer, the corporation that sells them, to call them back, to pay them back before they mature. So if it's a 10-year bond, let's say issued at 7%, and 5 years into the bond term, so with 5 years left, 5 years gone by, 5 years left, interest rates fall to 4%. The company can pay off their 7% bonds and then issue new bonds at 4%, so thereby reducing their interest rate. That's good for the company, not good for the bondholder. If you hold a bond with a 7% interest rate, you'd like to keep it. It's paying a really good interest rate relative to what you can reinvest your money in. So callable bonds are more attractive to the issuer and less attractive to the buyer of the bonds. Non-callable bonds, you have to keep, the corporation that issues them has to leave them outstanding until their termination date. And then there are registered bonds and coupon bonds. All bonds since the early 80s are registered bonds, which means that you don't physically get a bond document when you buy bonds in a marketplace. They are registered in your name, held by a brokerage firm of some sort. And when interest is due, it's mailed to you by check or transferred electronically perhaps. And you get the money directly, and the bond issuer knows who they're paying. They're paying you. And they not only know who they're paying, but they also inform the government that they've paid you interest, so the government can charge you taxes on that interest. And the reason that there's only registered bonds is that starting in the 80s, the US government said you can't issue the other kind of bonds, which are called coupon, or sometimes called bearer bonds. Bearer bonds were like currency. So you could own the bond, and whoever held the bond, whoever was the bearer of the bond, owned it. There was no legal tracing of who was the owner, beneficial owner of the bond. And the way that interest is paid on them is you clip the coupons, as the little picture on the right there shows. And when you clip those coupons, you then turn them into a bank teller. Bank teller gave you your interest for the month and then submitted those coupons to the corporation for reimbursement. No one knew who got the money. No one knew who owned the bonds. You were required to report them as income, but there was no way for the government to trace whether you'd done so or not. There are still coupon bonds out there. Any bonds issued before 1980, and many bonds are issued at 50, or some railroads issued 100-year bonds in the 1940s and 50s. So those bonds are still out there. They're still valid. So there are still coupon bonds out there. When I was growing up, rich people who didn't seem to have to work because they had significant assets were called coupon clippers, because they went once a month to their bank safety deposit box, took out their bonds, clipped the coupons, and lived on the interest. I think today most people call people like that trust fund babies. So they have trust funds, and they receive income from their trust funds and don't necessarily have to work. So that's what a coupon bond is. So here's just a summary of what we talked about. We've got secured bonds and unsecured bonds. We've learned the difference between them. I didn't talk about term and serial bonds, but term bonds are by far the most common bonds. The term bond means that the principal is paid back at the end of the bond. Probably 95, 98% bonds are term bonds. Serial bonds would mean part of the principal is paid back each time a payment is made, more like a home mortgage. That they're not very common. Most bonds are term bonds. Callable and non-callable we talked about. We haven't talked about convertible bonds yet, but we will shortly. They are bonds that are convertible to common stock. And then registered and bearer or coupon bonds we talked about. Bonds are fixed income securities. So the interest is fixed at whatever interest they're issued at. So a 5% bond is going to pay 5% till its term is done. 7% bond, 7%, and so forth. Because interest rates change in the marketplace, bonds are sometimes sold at less than face value or sometimes at more than face value. So if we think about Castine Investments, a fictitious company here, issuing a $100,000 7% bond, so this bond is going to pay $7,000 a year in interest. When other bonds of similar risk and maturity are paying 8%, would you buy the Castine Investment 7% bond? Wait a minute, I can buy a bond from Bucksport Investments that's paying 8% and they have the same risk profile and they're going to mature at the same time. Why wouldn't I give my money to Bucksport Investments instead of Castine Investments? Of course I would. If the risk profile is the same and the maturity of the bond is the same, I would take the higher interest rate. So how does Castine sell their bonds? They discount the face value. They don't change the percentage rate, they discount the face value. So they'll issue the bonds at less than $100,000, but they'll still have to pay the $100,000 back at the end. So they'll sell those bonds. In this case, I've done the math. They'll sell those bonds for $93,205, which will yield 8% to the investor to maturity. So the investor will get his 8%, his or her 8%. They will invest $93,000. At the end of the term, they'll get $100,000 back, and they'll receive $7,000 a year in interest. That's bonds being sold at a discount. Companies often issue their bonds at either a premium or a discount because they set the interest rate before they sell the bonds, and interest rates in the marketplace change. So you can't predict what the interest rate is going to be. The SEC registration process takes around 6 months for bonds. So when we decide to issue a bond, we set the interest rate, and then we actually issue the bond 6 months later. The market interest rate may well be different than what we set. So we end up selling bonds at a discount, or sometimes at a premium. So same situation, Castine Investments is paying 7% of their 10-year bonds. Bucksport Investment, the similar risk profile, is offering 6%. So the market is at 6%, but Castine is offering 7%. Which one do you want to invest? Well, clearly Castine, but Castine doesn't really need to sell them to offer 7%, so they issue their bonds at a premium. And the premium in this case, I've calculated, these are for 10-year bonds. The premium, they would sell their bond for $107,439, and the investor at the end of 10 years would receive $100,000 back. They would also receive $7,000 a year in interest. So two different scenarios, bonds sold at a discount, bonds sold at a premium. In many balance sheets, you will see those discounts and premiums showing up. That's why it's important to know. And you may end up buying bonds at discounts or premiums as an investment. Bonds that are traded after being sold, there's a bond market just like there's a stock market. Bonds can be bought and sold. They have no effect on the company once the company is issued them, just like stock. Once they've sold the bonds and received the money, I bought the bond originally and now I sell it, doesn't affect the company at all. The only thing the company does is record a new registered owner and pay the interest to a new registered owner. There's nothing else happens. Bond prices rise and fall in the marketplace based on market rate of interest. So market rates of interest change all the time. So when market interest rates fall, bond prices rise. Market interest rates rise, bond prices fall. So we can say that bond prices move inversely to interest rates. So market interest rates go up, means I can lend my money at a higher rate, so the bond that I hold is worth less because it's paying a lower rate, and so forth. So that's how bond pricing works. Very important to understand that when we pay interest on bonds as a corporation, it's tax deductible. So it's not like dividends. Dividends are not tax deductible. When I pay interest, it's tax deductible. This lowers the effective cost of the bond. So my 7% bond that I was, so I'm paying $7,000 a year on my $100,000 bond as Castine investment, I can deduct that $7,000 from my taxable income. And if I'm at a 30% tax rate, that means I save $2,100 on taxes. So my net cost of borrowing is not 7, it's $4,900. So 4.9% is my effective cost, not 7%. That makes a huge difference to corporations. So debt, because of our tax system, is more attractive than equity in many ways, because the cost of paying interest to a corporation is reduced. The person who receives the interest pays tax on it, just like they pay tax on dividends, but the corporation gets to deduct the cost of their interest from their taxable income. So it makes a big difference. Another kind of capital that's sort of halfway between equity, common stock, and debt, bonds, or bank loans, is called preferred stock. It has some of the characteristics that bonds have and some of the characteristics that stock has. From an accounting standpoint, it's part of stockholders' equity because it's permanent capital. We're not required to pay back our preferred stockholders. The money is permanent. That's why we consider it equity. However, it's permanent, but it has a fixed dividend. Like a bond has fixed interest, preferred stock has a fixed dividend. So the dividend might be 5% preferred stock, then we're going to pay 5% per year in dividends on that stock. The dividend is not going to go up to 7%. It's not going to go down to 3%. It's going to be paid at 5%, just like a bond. So it's going to be paid, but it's dividends. Bond preferred stock dividends are not deductible, so they are not as attractive from a tax standpoint. Dividend preferred stock tends to move up and down based on interest rates as well, because it acts like an interest-bearing security. But the tax treatment is different, and the balance sheet treatment is different because we never have to pay back the principal, which means that the person who buys preferred stock, it's not going to ever mature, and they're not going to get their principal back. So that's what preferred stock is. It's a pretty attractive investment sometimes. So why would a company issue preferred stock? The payments aren't deductible because they're looking for permanent capital. They can leverage preferred stock investment and borrow money at more attractive rates because the preferred stock is permanent, patient capital. So it's attractive for some companies. It gets used a fair amount. It was used a lot by the government, actually, in bailing out a variety of companies in the crash in 2008. The government, when they bailed out various banks and insurance companies, actually didn't invest in common stock, didn't lend money to those companies. They bought preferred stock. Companies issued new preferred stock to the government with quite high dividend rates, as high as 14%, and with the ability, the preferred stock was callable. The companies had the right to buy it back if they wished to, and the incentive for the companies was very strong because the dividend rate was so high. So they didn't want to pay 14% dividends. So as soon as they were able to improve their capital position and buy back the preferred stock, they did. So the government got their money back. In addition, the government preferred stock does not have voting rights. So the government wasn't put in the position of having to elect boards of directors and make management decisions, so that they didn't want to be operating these companies. And it worked out quite well for the government. They were able to buy this preferred stock, inject money into organizations that were at risk of failure, and those organizations all paid that money back. So the government, though having invested a lot of money in what was, I think, called the TARP program, they were able to recover all that money fairly quickly. So the preferred stock was used for that. A couple of kinds of preferred stock. There's cumulative preferred and convertible preferred, or there's several kinds, but cumulative preferred means that if the preferred stock is dividends and the company doesn't have to pay dividends, board of directors can say, no, I'm not going to pay dividends this year. Cumulative preferred says if you skip the dividend last year, before you can pay dividends to your common shareholders, you have to make up the skipped dividends. So we skipped dividends last year, we're going to pay dividends this year. The preferred stockholders will get 2 years of dividends this year before common stockholders get anything. And then we didn't talk too much about convertible bonds, but both bonds and preferred stock are sold as convertibles, which means you buy in this case, preferred stock, and it pays a fixed dividend and it's preferred stock, but you have the right to convert it into common stock at a fixed price. So let's say the common stock in a company today is trading at $20, and they sell preferred stock with a 5% fixed dividend, let's say, with a right to convert at $25 into common stock at $25. So I own my preferred stock, I get my fixed dividends. If the company does well and the common stock rises, I can convert my preferred stock into common stock. That's what convertible preferred is. Convertible bonds are the same. I have a fixed lending. I've lent money, and I can convert them to common stock at a fixed price. If the market rises, I can convert my bonds to common stock and participate in the rise in the value of the stock. Generally speaking, if it's either cumulative preferred or cumulative convertible preferred or convertible bonds, those instruments will carry a lower dividend rate or a lower interest rate because of the convertible option. So you get less. It's more attractive to the investor. They're willing to accept a lower price. So that's the end of as far as we're going to go for Chapter 5, Part 2. So we've talked about how companies acquire money from equity. We've talked about how companies acquire money from debt. And then in the next section of Chapter 5, we're going to talk about how we use that. What's the cost of that? So thanks very much, and I'll talk to you later.